think we're going to get started with the program now for the evening. I think we have a great program prepared on microcap investing. And so I just want to introduce our speakers for tonight. We have Paul Carter here, who's a principal at Point Defiance Capital Management, which is a long-short microcap investment management company based here in Tacoma on Pacific Avenue. Paul used to be at Russell Investments, where he was a senior portfolio manager, and previously he worked in Russell's Canadian Equities Group. We also have Dennis Jensen, who's a principal at Acuitas Investments, which is a microcap-focused multi-manager firm. And Dennis was also formerly at Russell as a senior analyst and portfolio manager with large cap equities in a number of different asset classes. And so really appreciate them being here tonight. Also just want to say a couple quick thank yous. First of all to Anne-Sophie Montgomery and also to Jyoti, who are volunteering here today. Also to the Society for helping to sponsor this event. And also wanted to give a quick plug. We have a contingent from the PLU Masters of Finance program here today. So they've been told that they will be approached by random members of the audience who will ask them questions, and that all those will be graded. So if you'd like to try to seek them out and ask them finance questions, they will be quite nervous. So without further ado, I'd like to introduce Paul Carter to get us started. Thanks so much.
Great. Great. Well, thanks very much, everybody, for being here this afternoon, and thanks to Bard and CFA Society of Seattle for organizing this event and inviting me to speak. Before I start, I just wanted to make the point that at Point Defiance, we do not believe that U.S. microcap stocks as an asset class is going to outperform other asset classes going forward. Your guess is as good as mine, in fact, probably better than mine, as to whether microcaps are going to outperform in the future. At Point Defiance, we focus on microcap stocks simply because we believe there are pricing inefficiencies that exist there that are much greater than the inefficiencies that exist with larger companies. And this is because there are relatively fewer investors who spend the research time necessary to uncover these mispricings. And there are fewer investors looking at microcaps in part because there's a lot of conventional wisdom about microcaps that keeps investors from focusing too much here. And I'll go through some of these commonly held beliefs today about microcaps and explain where I think these beliefs are perhaps more myths than reality. So to begin with, the terms penny stocks and microcap stocks are often used interchangeably, but it's important to distinguish between the two. Microcap stocks are simply shares of companies that have small market capitalizations, while the term penny stocks generally refers to stocks with stock prices below $1 and that trade on over-the-counter quotation systems like the OTC bulletin boards or pink sheets. Penny stocks are usually what people are thinking of when they think of boiler room operations or pump and dump schemes, etc. Whereas a large portion of microcap companies are actually reputable companies with long histories, quality financial reporting, and that trade on national exchanges like NASDAQ or the New York Stock Exchange. Even the SEC adds to the confusion a little bit through its guide to microcap stock investing that it's got posted on its website. And some of the warnings which I've noted here, such as lack of public information and no proven track record, are really more about penny stocks than microcap stocks. And just to be clear, today I'm not going to be talking about penny stocks. So there's no exact definition of what a microcap stock is, although various index providers have created their own definitions. While each index provider has its own set of criteria that it uses in determining whether a stock is a microcap or not, I've included on this slide just some basic market cap ranges and averages for each of the indexes created by MSCI, Russell Investments, and Dow Jones. Throughout my presentation today, though, I'll refer to Russell's microcap index simply because I used to be employed by them and I'm familiar with their indices. As well, their indexes and methodology are really transparent. So on the next slide, This graphic just demonstrates how Russell segments the U.S. equity universe by market cap. And this is how I compare stocks in some charts that follow. Every year, Russell reconstitutes its Russell 3000 index, which includes the largest 3,000 stocks in the country, and then splits this index up by market cap. On the left is that split. So the top 200, or the largest 200 stocks in the country, are put into the Russell Top 200 index. The next 800 stocks comprise the Russell Mid-Cap Index, and then the Mid-Cap Index plus the Top 200 Index equal the Small Cap 1000 Index. And then stocks 1001 through to 3000 equal the Small Cap Russell 2000 Index. The Russell Microcap Index consists of the smallest 1,000 stocks of the Russell 2000 plus all other stocks above $1 that trade on national exchanges down to about the $30 million market cap level. So as at the last reconstitution of the Russell indices last year, the Russell Microcap Index consisted of all stocks between 30 and 565 million. So during my time at both Russell researching investment managers and at Point Defiance talking to investors, I have tended to hear the same misgivings about investing in the microcap space over and over again. And these are just some of the commonly held beliefs that people in the industry often have. First, microcaps are nothing but a collection of little tech and biotech names, and this universe of stocks doesn't offer investors much sector or industry diversity. All microcaps are very low-quality stocks that are not investment-worthy, and to be successful investing in this space effectively requires investors to find a needle in a haystack. The high costs of trading microcaps make investing in this space unpalatable. It is very hard to borrow these stocks and then short them. Therefore, if you're going to manage an investment fund in this space, you really have no choice but to be very long biased. One comment I've heard multiple times is the tree falling in the forest comment. That being that even if something really good or bad happens to a microcap stock, since they are so underfollowed, does anybody even hear, or does the news get impounded into stock prices? And finally, microcap stocks tend to move together much more so than larger companies as investors shift their preferences for or against risky assets. So investing in a microcap fund exposes you much more to microcap risk than to stock selection risk. So I'll now touch on each of these. First, the sector diversification belief. Hopefully you can see this chart on the bottom here, but this chart shows the number of stocks by sector within each of the Russell Microcap Index in blue and the Large Cap Russell 1000 Index in gold. And this is not capitalization weighted. Rather, I just took the number of stocks in each sector to demonstrate the breadth of opportunity. As you can hopefully see, the microcap index is a little bit more concentrated among a handful of sectors than the Russell 1000, but not by much. For instance, about 71% of the microcap index's constituents are in 4 sectors: financial services, healthcare, consumer discretionary, and technology, versus about 65% for the Russell 1000. And there aren't that many dramatically large sector differences either between the two indices. For instance, about 14% of the microcap is in tech stocks versus 12% for the Russell 1000, and about 16% of the microcap is in healthcare versus 9% for the Russell 1000. So other than maybe consumer discretionaries on the left and utilities on the right, where maybe there's only a few dozen stocks each in the microcap area, you can find lots of investment opportunities in every sector. The next belief held by many investors is that microcap stocks are of dubious investment quality. Now, investment quality means different things to different people, but one way to measure it is just to see what percentage of stocks have generated decent returns for shareholders. So on this chart, I've tried to demonstrate that by looking at the percentage of stocks within each index that have a trailing 12-month return on equity of greater than 10% in the blue and greater than 20% in the gold. On the right-hand side, you can see roughly 1 in 4 microcap stocks have a trailing ROE of greater than 10%, and about 1 in 12 microcaps have a trailing ROE greater than 20%. These percentages are well below those of large, mid, or small cap stocks. So this definitely does lend some support to the argument that microcaps are, on average, lower quality than large cap companies. But in absolute numbers, there are still well over 300 microcaps with ROEs in the double digits and over 100 microcap stocks with ROEs greater than 20%. And on top of this, microcap stocks are, in many cases, relatively well-known household names. These logos are just some of the companies that you'll currently find in the Russell Microcap Index, but there are many, many others, such as Big Five Sporting Goods or Martha Stewart, Smith & Wesson, etc. And while strong brand identification isn't necessarily synonymous with investment quality, it does come as a surprise to many investors that the world of microcaps isn't just full of tiny fly-by-night companies that very few people have ever heard of. Many investment managers don't manage microcap investment products because it's difficult to run a microcap fund of sufficient size to make it economically palatable. And that's because the costs to trade microcap stocks are meaningful. This commonly held belief is certainly not a myth. The total cost to trade a stock is comprised of 3 components. Market impact, which is the effect that a market participant has when buying or selling an asset. The cost related to the bid-ask spread, and then finally commissions. So for many institutional investors, where a stock's position size has to be in the hundreds of thousands or even millions of dollars to be meaningful to them, the costs related to market impact can be huge. The more shares you have to trade, the greater the market impact will be. So this chart shows how trading volumes differ depending upon the market cap of a stock. In the first quarter of 2013, just by way of example, the median daily dollar volume of the Russell top 200 stocks was $225 million a day. So if you're an investment manager that wanted to adjust your Apple position by $3 or $4 million, you could probably do that relatively quickly without moving the stock very much. Even mid-cap stocks traded $40 million a day on average. Small caps, on the other hand, had an average of about $2.5 million, and then microcap stocks traded a mere $400,000 a day on average. Having said that, the distribution of median daily dollar volumes by microcap stock is quite big. While some stocks on the right, or on the left here, trade very little, roughly 60% of the universe traded on average at least $250,000 a day, and more than a quarter traded more than $1 million of stock a day on average. So while trading volumes do present a challenge to large investors in this space, there are nonetheless hundreds of microcap stocks that do trade at volume levels that are perhaps surprising to some. Trading costs, though, next slide. Trading costs, though, as I mentioned, also include the effect of stocks' bid-ask or bid-offer spread. Looking at a stock's typical bid-ask spread is another way of assessing a stock's liquidity. While on any given day there may be only a few cents separating the highest bid price and the lowest ask price for Apple stock, as an example, it's not at all unusual to see a spread of a quarter or more for many microcap stocks. And to demonstrate this, on a few different trading days in April, I calculated the average bid-ask spread for each stock in the U.S. equity market. And this chart shows the median bid-ask spread by index. While the typical bid-ask spread for large cap and even mid-cap stocks was pretty close to zero, it was roughly half a percentage point for microcap stocks. Now, although 53 basis points may not seem like a lot, if you're an active trader, this bid-ask spread can eat up a lot of your profits, even at very modest asset levels. Many long-short managers in the microcap space run their portfolios very long biased. In other words, for every dollar that they would go long stocks, they may only go short 25 or 50 cents. As well, while their long portfolios are focused on microcap stocks, their short portfolios are often full of small, mid, or even large cap companies. And this has always sort of struck me as opportunity wasted because, as I outlined before, microcap stocks are often money-losing companies with maybe not so great business models where managers might be able to generate additional returns by shorting them. Now, one of the arguments for this approach by managers is that it's relatively difficult to borrow and then short microcaps. Or if you can borrow them, the interest rates that brokers charge investors for borrowing stock is much too high to make it worthwhile. While this isn't a complete myth, I do think this belief is overstated. Now, the ability to borrow a stock is dependent on part on how much others have already shorted it. So this chart if you could just go back one. Sorry, back 2 slides, I think. Right. So this chart shows the median short interest as a percent of a stock's public float. As of this month, mid-cap and small-cap stocks, on average, had 3.3 and 3.8% of their public floats shorted, whereas microcap stocks have, on average, only about 2% of their float shorted. And for the last few years, at least, these numbers have been pretty consistent. So this suggests that it might not be terribly difficult to locate microcap stock to borrow and then short. Now, while I don't have industry-wide statistics regarding the actual ability to borrow microcap names, we did recently check with one prime broker that was able to provide us stock locate information for all stocks within all the Russell indices. And the results were actually surprising. Over 90% of the stocks within the Russell microcap were borrowable and shortable. And then in terms of how much this broker charges for shorting these stocks, which is called the short rebate, less than 20% of microcap stocks required the payment of more than a percentage point annualized. Now again, this is just one prime broker, but I think that this data provides some evidence that shorting microcap stocks is not nearly as hard or as costly as some people might think. Because many investors believe microcap companies are low-quality investments, because of the belief it's too hard to short these stocks, and mainly because of the cost of trading microcaps, there are very few investors researching these companies, relatively speaking. This chart shows the median number of sell-side analysts that cover the stocks within each index. The typical top 200 company on the left has 20 or more analysts covering it. Apple, for example, has, I think, 57 analysts currently covering it. The median microcap stock, on the other hand, has only 2 analysts covering it, and more than a third of them have either a single analyst or no analysts formally covering it at all. Now, anecdotally at least, I can tell you that this lack of research coverage extends to the buy side as well. I mean, some of the companies that we talk to in the microcap space tell us that they don't field more than a few investor calls a quarter, which suggests to me that maybe the depth of research being performed on some of these companies is not terribly high. Since microcaps are relatively underfollowed, one belief that some people have is that even if something good or bad happens to these companies, you don't get rewarded for doing good research and then taking positions in these stocks. This chart is one way of demonstrating that that is a big misconception about this space. For the third quarter of 2012, we looked at each stock's return from one day before until 4 days after the company reported earnings. And in 16% of the stocks within the Russell Microcap Index moved more than 10% one way or the other around their earnings report. And that's compared to about 2% of the largest 200 companies. So this goes to show that being on the right side of earnings pays off much more the further down the cap spectrum you are. And in one argument that I've heard from institutional investors supporting their decision not to invest in microcaps is that microcaps are often very highly correlated with each other. And this belief is absolutely not accurate. Microcap companies often have very concentrated customer lists and or relatively few products or services to sell. So therefore, they have very event-driven movements, much more so than larger companies. A single new or lost client, an FDA approval, or a factory shutdown, what have you, can cause microcaps to move dramatically in one way, in one direction or the other, regardless of market trends. So to test this, I took the monthly stock price changes of all stocks within the 4 Russell indices over the past 3 years, and then calculated the correlations of these stocks' returns relative to one another. And then for microcap stocks, the median correlation was only 20%, or about half that of the large cap universe. So just to summarize, I believe these are some of the key points about investing long and short in a microcap space. First, investors are not constrained by the amount of opportunities by sector or industry. While there are many, obviously many more struggling companies with suspect business models in the microcap space than there are stocks that have blue chip potential, there are still plenty of good opportunities in this area for investors to focus on. And even at relatively modest asset levels, trading costs are significant and should be considered by investors. There's surprisingly little competition to short these names, and investors can add value by shorting them. News moves these stocks much more so than stocks further up the cap spectrum. And finally, microcap stocks individually tend to march to the beats of their own drummers, a lot more so than larger companies. So that concludes my prepared comments. Pass it to Dennis.
Thanks very much, Paul. I'd like to introduce Dennis Jensen. He's going to say a few words, and then we're going to move into the panel discussion part of our program. So please reserve your questions until the panel, and give the floor to Dennis. Thanks so much.
Thanks, Bart. I'm holding this. I don't have a mic, so wave it around, but it's recording as well. Paul's part of the presentation. That was really the meat of the presentation. I'm going to try to keep this relatively quick, but there are a couple angles I wanted to come at it that were a little different. Obviously, Paul and his firm are buying individual stocks or manage a fund that buys microcap stocks. We're coming at it from a multi-manager perspective, where we're going and finding managers that invest in microcap stocks and putting those together into portfolios. But I wanted to dig a little deeper on why do people focus on microcap? So why, for example, does Paul and Point Defiance buy microcap stocks? Why did we go out and why do we choose to focus on an inefficient space like microcap? We also do international small, which has a lot of the same characteristics. But then also, why do a lot of people not do microcap if we think the opportunities are great? And it's not a coincidence that a bunch of Russell alum have decided to go out and focus on microcap. We got to look at a lot of different spaces, and we all I'll say independently, it wasn't independent. We all came to similar conclusions, though, that the opportunities are great in microcap. But a lot of people who know, Paul was educating you on microcap and giving some sort of dispelling some myths. Why do people, there are a bunch of institutional managers that already know that, professional money managers that choose not to invest in microcap stocks. So why is that? I want to dig a little deeper on that. And then just go over a few of the challenges if you are going to invest in microcap stocks, or maybe look at managers that are investing in microcap stocks. What are some things you need to be aware of? A lot of this Paul touched on already. Clearly the key point for me, the inefficiency, because nobody's paying attention, it creates better return opportunities, better active management. You can't just invest naively in microcap, then it becomes a game, like Paul started or led with, is that actual asset class going to win or lose? That's not the game we're playing. We're playing the game that we think that you can win by being better at investing in microcap stocks because they're inefficient. And of course, there is little institutional attention. I'll cover that better. It is diversifying. Paul already went over that. Another interesting angle, it does share some advantages of private equity. Private equity by nature is a very inefficient space. Obviously, microcap is far more efficient than that, but it's closer to that than any other space within the publicly traded U.S. equity markets. You have some of those characteristics, but you don't have some of the risks, some of the liquidity constraints that you get in private equity, for example, much, much higher fees typically. There is another angle that the microcap stocks are easy M&A targets. Not only that, but sometimes the valuations are better when they're taken out because they're taken out by big companies that don't care about a point or two multiple on these little tiny companies. They're doing it more for strategic purposes often, so they want the product that this company has. Apple comes in and buys some little company. They don't care if they have to pay another $50 million, but they want the product for strategic reasons. So go ahead and flip it forward. So this kind of support gives some data on why people like Paul and Brad and I have chosen to focus on microcap. This is the excess return, so return versus the benchmark of a bunch of different of the cap spectrums over time. 1 year was a tough year, but you can see over the longer periods, the darkest blue bars is the microcap. So the microcap managers were able to, this is the average microcap manager according to eVestment, was able to significantly outperform their benchmark, the Russell Microcap Index, where small cap, pretty good history of success, but it pales in comparison to microcap. And of course, large cap is kind of flat to negative. And again, that's the average large cap manager versus their own benchmark. And I apologize, our data is a little old. I didn't update it from last year. Okay. So obviously, if those types of returns are available to the average manager, our goal is to try to find better than average managers, and that should give you, I guess maybe a way to put it is we are looking for ways to put the wind at our back. One way to do that, I guess to create an opportunity to perform better, is to focus on the inefficient space. So why doesn't everybody do it? Like I said, there are a ton of professional money managers that don't focus on microcap. First point here is the large investment managers can't manage enough money to support the infrastructure that they have. And Paul touched on that point earlier. You get the large firms like Fidelity, Russell, whoever, that has a very large infrastructure. They have a lot of money to invest. They can only invest, I'll say, $200 to $500 million, for example, in microcap. And they have a very large infrastructure to support, a lot of layers of management to support. Managing that much money doesn't move the needle for them at an organizational perspective. If you stay small and remain a boutique, or you are cost conscious, you can manage a business there, no problem. But the biggest money managers don't go into microcap because it doesn't make sense for them from a business perspective. Large brokers don't cover microcap stocks because it doesn't generate trading volume. My partner loves to tell a story about a little online dating service that called him. He was part of the technology team at a Wall Street brokerage during the internet bubble. They called him and they said, look, we've got this great company. We want to go through the financials with you and all that stuff. We have 20,000 paying subscribers, which was crazy in the internet bubble to have a bunch of paying subscribers and actually be profitable and stuff like that. And he said, well, that sounds great. You're probably going to get bought by somebody, but there's no way we're going to cover you because it wouldn't generate any profits for us. So they're just not paying attention. They don't cover those stocks. Investors, professional investors that do rely on brokerage research reports for their research, obviously are at a disadvantage because it's not available in microcap. And a lot of the competitors, so in theory it's a zero-sum game. The active management buying stocks in a specific universe, you would think some winners and some losers, and they offset each other. Your competitors in the microcap space a lot of times end up being less sophisticated investors, smaller regional brokers, individual investors, insiders, families, things like that. For the professional investment manager that is looking at the whole universe, in theory they should be able to, they have even a little different motivations that allow them to win in that environment. So I say the bottom line is most investors aren't trying in microcap, creating a lot of inefficiency. Okay, last slide, last bullet point slide. Some challenges for managers. You have this constant tug of war between resources and business viability. If you're a large cap manager, you can, in theory, manage billions of dollars, tens of billions of dollars more. You can hire a whole bunch of analysts, have somebody dedicated to each sector. You can have lots of operational infrastructure. For our firm, we don't have the luxury of being able to do that because we're not going to manage tens of billions of dollars. We can't. That would be too much money to manage in the microcap space. So get into the second point, efficiency becomes far more critical for an investment team to really focus on the key points that are critical to an investment process. You have to do great. You have to have an efficient process for idea generation, an efficient process for getting the information necessary in the stocks that you're going to invest in. But it is far easier to gain an informational advantage because fewer people are looking at these stocks. You can call a CEO of a microcap stock, and usually they'll answer the phone and talk to you and be happy to talk to you and get excited about it, where you try to do that for a big company and you get the IR or investor relations department. Although, I note that with power comes responsibility. If there is no street research out there, even if street research doesn't have much quality, in theory, or in my view maybe, you are on your own. You're the only one doing the research that you're relying on. It's often difficult to have anything to check that research against. So you better make sure you're doing good research and digging into the companies. Does anyone care? Discovery is powerful. Paul was talking about the idea of the tree falling in the forest. If you can identify a stock, there are some stocks that people aren't going to pay attention to, I believe, even when something good happens, or at least it's going to take them a while to notice. But if you can identify stocks that are on the verge of being noticed by other people, that has a compounding effect on the positive impact of positive news. Avoiding the garbage, some of the stocks, the unprofitable stocks, relatively new, sort of penny stock characteristics that Paul was talking about earlier. There is some pretty simple advantage to just avoiding some of those garbage stocks. And the final point is that we've come at from several angles. You can't manage too much money. So from a multi-manager's perspective, that's probably the number one thing that eliminates managers in the microcap space is managing too much money. And if you flip the slide one more time, I'll show you why. So we have the microcap index on the right. Again, sorry if the data's 9 months old, but this is the 10-year return for managers in different buckets according to AUM. So the index is on the right, the larger managers next to that. Now, in the microcap space, they still outperform, even though they're not outperforming by much. But if you go into the small managers, less than 100 million in assets, you can see their return completely dwarfs the other buckets. There's survivorship bias and things like that in there, but I think the sort of the magnitude and direction is more important than the actual numbers. And it's not a coincidence that people like Point Defiance aren't going to take more than $100 million because they want to do everything they can to keep the wind at their back. Okay, it probably went longer than I should, but I think we're ready for question and answer.
Yeah, thanks so much, Dennis. As Dennis said, we're going to sort of start the panel discussion part of the program. We have one question just prepared to kind of get things started, and then after that, please just raise your hands, with your questions, and we'll have some good time for questions. So, Paul and Dennis, both of you guys mentioned how low analyst coverage and informational inefficiencies or informational advantages in the market are key differentiators for microcap as an asset class. So what behaviors or background or other factors do you look for, in terms of managers to generate this factor? And without giving away the secret sauce, what can investors look for in managers? From that perspective.
I'll start with that because it's more manager oriented. We try not to have too many rules that we just categorically rule out managers, but one thing is we like the managers that recognize and exploit the inefficiency in microcap. So we are naturally going to have a bias against managers. I noted that the people that require broker research for stocks that they're going to invest in, we like managers that embrace the fact that there is not Wall Street coverage on a bunch of the stocks in the microcap universe and go out and do their own research. So that's one kind of embracing the inefficiency instead of shying away from it is maybe a general characteristic I would note as far as broker coverage. Do you have anything to add to that?
Yeah, I mean, I would. We're obviously biased. We're a fundamental long-short manager, and to Dennis's point, I think CEOs and CFOs of microcap companies are more than willing to talk with investors, professional investors or individual investors. And I'm surprised sometimes, actually, in the microcap space, despite the fact that there are a lot of professional investors that do focus in this area. Maybe the depth of the research that is done on some of these names is maybe not that high. So definitely, I would say, in looking at investment managers, ones that really do deep fundamental research and actually talk with the company's CEOs, CFOs, or whatnot can add a lot of value.
Thanks. Anyone in the audience have a question? Yes.
Just a general question about what do you see with regard to balance sheet structure, maybe a little less debt versus equity in the microcaps, and what is the relative cost of capital? Do they have a disadvantage in that regard on the smaller caps and microcaps?
I'm going to repeat the question to the microphone. So the question was, in the microcap space, what do we see with balance sheets, debt versus equity, and what was the second part of it again?
Cost of capital difference.
And the cost of capital difference.
Good question. Currently, because of what happened in 2008, 2009, I don't have statistics to support this across the universe, but we're seeing more and more microcap companies that have a lot less debt, a lot more cash on their balance sheets than they did maybe 5 years ago, and probably less so than larger cap companies. In terms of cost of capital, yes, on average, it is higher. Lines of credit and interest rates and whatnot, even though they are quite low for sort of anybody with decent sort of investment quality. For microcap companies, the cost of capital definitely is still higher than larger cap companies.
One thing I really enjoy about doing multi-managers, we get to talk to lots of different managers and sort of think about their approaches. So it gives you good breadth. Some perspective we have on debt within microcap. You get some correlation with other factors maybe that cause it to differ on whether or not debt is good. So there are situations where debt can actually be an indicator of quality for a microcap company because they are able to borrow money. But those are typically profitable companies with good ROEs and good cash on their balance sheet. So in a way, it's kind of the old adage that the best people to loan money to are those that don't need it. But when I mentioned the idea of avoiding the garbage in microcap, those are the combination of high debt, low profitability, not great cash, maybe sort of very cyclical individual product dependent companies that aren't thriving often. So those are, you get the opposite signal there. They need that debt, and they don't have the profitability and structure to support it necessarily.
Someone else? I'll take in the front.
Over the course of time, have you seen a lot of microcap companies transiting to small cap or to mid cap or further? Because what's the turnover like of the microcap index? Because that can be an indicator of the growth.
So the question is transition from microcap to small cap or higher. Dennis or Paul?
Actually, one slide that I almost included in here was I did an analysis of where are they now, and I looked at the Russell microcap constituents from back in 2005, and there was about 2,000 stocks in the index then, and wanted to see what actually happened to them now. More than half of them are no longer, or the tickers no longer exist, and some of those mean the ticker symbols have changed. Some companies have gone bankrupt. A lot of them actually got taken over the last sort of 7 or 8 years. There's a handful of companies. I know Boston Beer was one of them. Green Mountain Coffee Company was another that were up between 7 and 10 times from the market caps that they were at back in 2005. But it really is a very, very small percentage of the companies. So definitely microcap companies can and do sort of migrate into small cap and even mid cap territory. But there's a much greater chance that a microcap company gets taken over well before that happens.
Okay. Great. At the back. Yep.
What do you look for when you're, not to give away your secret sauce or anything like that, but what are you looking for in the microcap industry? I know that you had mentioned Green Mountain Coffee and another one, but back in 2001, there was a company called Stratasys who makes a three-dimensional printer, and they're still out there today. And by Benjamin Graham's definition of a net back in 2001, it was a net. And so, is that what you're looking for when you're looking at microcaps?
So the question is, what factors do you look for a winning microcap investment?
Say what you're comfortable with.
Yeah. In a microcap space, I still believe the same factors that drive returns in small, mid, and large cap space are drive returns in microcaps. What we're looking for, as an example, is just good business models where companies have a sustainable competitive advantage, are able to generate decent returns for shareholders, and that are run by quality management teams. One maybe difference microcaps versus larger companies is that the management team running it can have a much greater impact on the long-term success or failure of that company. So ultimately, when we're looking for companies to invest in long, and we tend to be longer-term holders, we really want to make sure that we're comfortable with the management teams and that incentives are aligned, and that we're confident that the CEOs and CFOs, et cetera, are actually going to be working in shareholders' best interests.
Sort of coming at it from a multi-manager perspective, I am a huge believer that investment strategies can win, or all different types of investment strategies can win. So there are managers we invest with that are more sort of the cigar butt type philosophy, deep value. There are some characteristics we like to identify, or that we like managers to emphasize when they have that sort of approach. So is there ever any reason why that company would be noticed by somebody else or would transition into, we typically don't like managers that are just buying people based on the balance sheet with no prospects for improvement, takeout, catalyst for restructuring the balance sheet, spinning stuff off, something that would cause investors to notice. But we also invest with momentum-oriented strategies that are identifying high-growth stocks. I guess in the microcap space, in a sense, momentum can even work better because it is a signal that the market is starting to pay attention to something good happening at a stock. And often that happens very gradually at first, and then maybe an analyst picks up coverage, and that you get that discovery effect. That sort of, I guess, to look at it from a different way. In large cap, managers almost always have some form of the three circles that overlap that embrace some kind of quality, some kind of positive change or growth, and some kind of valuation. And they want a company with all three. But they define those things completely differently. The one I would add in microcap is that an awareness of the potential of the discovery effect. So not only do you have good things happening at a company and it's trading at an attractive value, but all of a sudden you think people are going to start caring. So you get an extra boost on the multiple. Did you have a follow-up, Brian? Okay.
Thanks, Dennis. Next question. I'll take over there and on the side. Yep.
Do you ever take a controlling stake or need a controlling stake in your microcap companies? Are you can influence the company itself?
The question is, do you ever take a controlling stake or a sort of an activist position?
We have not, and our approach. There's pros and cons to doing that. Our approach personally is we probably wouldn't do that. There's pluses and minuses of taking the sort of activist kind of approach. I mean, the pro is that you can potentially influence behavior, which hopefully accrues to your benefit. The con is that you take on a lot of illiquidity risk, and you become a lot less nimble in doing that. And again, just personally, that's an area that we don't do, but others have certainly done that effectively.
Quick comment on top of that. We have followed a few managers that do that, but again, I think all types of strategies can win. But one thing, even from Paul's perspective, people that aren't looking to do that, you still have the advantage that you're having a dialogue typically with the CEO and asking them leading questions or whatever. They will pick up on things that you think they should do sometimes, even if you're not taking a controlling stake. And a lot of times these are far less sophisticated managements than you get with really big companies that either don't want to talk to you or aren't going to listen to you if you tell them.
Thank you. Thanks, Dennis. Over here.
Actually, two questions for Dennis and one for Paul. Pretty quick ones. For Dennis, when you're looking at adding a manager to your strategy, how long of a track record do you require in terms of years or quarters for that manager to have in order for you to even consider looking at them for inclusion in your product?
I'll hit that.
Questions on track record.
Yeah, that's actually, I kind of meant to make that point during my presentation. That is something that is, one, I'll say very different in the microcap space. A lot of, to directly answer your question, 0 is the appropriate answer. We do not require a track record. We do require the ability to gain confidence in the investment manager's history and experience, and we need to have perspective that allows us to build confidence in their skill. But that is one of the most counterproductive things to do in microcap, is to put on these what I call artificial constraints on who you're willing to pick. Because most consultants and a lot of the big institutional investors have those constraints, which is automatically going to put you out of the best managers in microcap. Because invariably they're going to require $100 or $200 or $300 million in microcap, and you've already put yourself out of that universe of managers that are going to do the best. So asset size is a counterproductive screen or requirement. Length of track record is correlated to that. We want to get in as early as possible so that we can be there for the sweet spot of their life cycle when they're small and nimble. Now, granted, length of track record does not mean they're managing too much money. Sometimes you get a fantastic opportunity where you can love a portfolio manager who's been managing $2 million for 5 years. I mean, that's a great opportunity because you can actually look at how they have been managing that specific portfolio and build more confidence. But usually if they're good, by that time the money is flowing. And once microcap managers start to take off and start hitting consultant check boxes and radar screens, then they fill up fast.
And so the second question was, what's the smallest AUM manager will you consider? And you don't really have a limit there also.
Right. I'll repeat it. For the second question was, what's the lowest AUM? And yeah, the answer is 0. Again, we need to have some way to look at a portfolio manager's history, experience, and all that, and, to be able to have a dialogue about their process and that. But we like spin-outs, small cap teams or micro cap teams spinning out of large institutions that want to be in a boutique, a more dynamic organization, have more control of their destiny, or sometimes the large organizations just making them manage too much money, which is a perfect opportunity for us because we want to get in early again. Sorry.
And the question for Paul was, due to the higher cost of trading, do you try to focus on or favor a longer holding period than you would otherwise? And can you talk about your average holding period or what your strategy is there based upon the cost of trading?
The question is, because of the higher cost of trading, do we have a longer holding period, and what is a holding period? I mean, there are managers out there that actively trade microcap stocks or more actively than us. We've taken the approach that the trading costs are very real, and therefore our holding periods tend to be quite long. In years, multiple years in some cases. And again, it's not that managing microcaps can't be done successfully at higher turnover or higher levels of turnover, but it's a personal choice that each manager has to make. And we just believe that the, even at relatively modest asset levels, transaction costs can be quite large in a microcap space. Not just when you get into a stock, but oftentimes liquidity in these microcap names can change pretty dramatically. 1 month, a stock may be trading 1 million shares a day, and then 6 months later, it's only trading 50,000 shares a day. So you have to be very cognizant of that when you are managing money in this space.
I'll take this question here and then over on the left. Please.
So I know that most of these companies or all these companies are traded on national exchanges and have to get their financial statements audited. But do you see ever, because of a kind of a lack of scrutiny, more aggressive accounting practices employed by these companies, whether it's purposeful or just maybe because of lack of expertise?
So the question is about differences in accounting practices, potentially, or more aggressive accounting among microcap. Paul, Dennis? Yep.
I would say at the margin, maybe more than at the margin. Yes, in the microcap space, there, we haven't sort of come across any outright frauds or anything like that. But sometimes the accounting is a little bit suspect there, or at the very least, the disclosure is not nearly as good as you often see with large cap companies. There's numerous cases where when it comes to something like revenue recognition or the valuation of a off balance sheet liability or something like that, in the microcap space, there may be very, very few words in the annual filing related to that. So I think there are cases, and we spend a lot of time sort of looking at accounting and making sure that companies that we're considering going long in actually have good accounting. We always say that sort of accounting disclosures are like a window into a manager's soul, and companies that are very aggressive on accounting, sometimes there's other issues with that company as well.
Great. And over at the side of the room? Yeah.
Yes. What sort of percentage of average daily volume do you start to get uncomfortable that you may be a little too large on a relative basis to exit gracefully if you so decide?
So position size as a percentage of average daily volume is a question.
I guess the unsatisfactory answer to that question is it depends. And, we look at it really from a portfolio basis. There are, some companies, both long and short, that we may be, comfortable being, multiple days or trading volume or something, whereas if there's other bigger pieces of the portfolio that are trade a lot more actively, we're comfortable with that trade-off. And again, to the point that I made earlier, liquidity can change really dramatically in the microcap space, and as a manager you always have to be cognizant of that. So just looking at how your position is or how your portfolio is positioned now relative to say the last 3 months trading volume may give you a false sense of security sometimes. So
not only does it depend on the stock, but it depends on the investment strategy. Deeper value, longer term holders probably can hold a little more of ADV and things like that than real fast twitch momentum type traders, because one, they're trading so much more often. It's going to be less frequent that they're going to get themselves caught in a situation, a falling knife, where they need to get out quickly, and it's going to cost them a ton of money on the trading side. So the risk there is a little lower. But the guys that are trading on sort of short-term inflection points and also getting out quickly on short-term negative inflection points, it can be a little more costly if they want to get out quickly and there's some negative news going on, so everybody else is trying to get out quickly as well. So those people need to be a little more mindful, although it's very, very few cases do we run into where we think the manager should run as much as they think they should run, no matter how they measure it.
management fee as opposed to the total expense ratio. It's the manager's compensation fee to them. What is it running in the microcap space compared to, we obviously see a lot of compression on fees in the larger market cap ranges, but are microcap managers able to command higher fees?
The question is on the range of management fees in the microcap space.
Definitely the microcap managers demand a higher fee because they're going to manage a lot less money. They think they're going to deliver better returns. We would tend to agree, so we're willing to pay more. So those are always arguments for charging a higher fee. There's so much less capacity out there. It's harder to identify the managers. Consultants, for example, institutional consultants like to identify a large cap manager and ride that manager for the next 15 years so they don't have to find a new one. In the microcap space, they have to go out and find new ones every 3 or 4 years because they fill up so fast. More direct answer to your question, we think 100 to 150 basis points for a long-only microcap manager encompasses probably 75% of them or more. Of course, when you add shorting in, it becomes more of a hedge fund structure where you get performance fees and things like that. But I think 125 probably is a good average.
Are there any other questions? Yes, one last.
Do you have any special requirements from investors as far as the amount of investment or holding period?
So the question is, in the microcap space, are there more requirements for investors in terms of the holding period or the...
It varies considerably by manager. Hedge funds are going to have, and these guys technically are a hedge fund, so they have, I don't even know exactly what they have, but I'm assuming sort of typical hedge fund lockups. Most of what we do is long only. There are some mutual funds out there available where you can, you get daily pricing, you can get in and out as frequently as you want. Most of them manage, again, I'm on my soapbox on managing too much money. Most of them manage too much money. Certainly not all. There are a few sort of unrecognized ones out there still. In our structure that's available to individuals, we do have a short lockup, for example, just because you don't want your if your investors are getting in and out quickly, then you have to be selling and buying quickly as well, and you don't want that type of turnover. Do you want to add to that?
I can't talk about our fund and what we do, but in the microcap space in general, it's really important to make sure that the investors' interests are aligned with the manager's interests, and oftentimes investors, really like the inefficiencies of U.S. microcap or other inefficient asset classes, but also want the sort of daily liquidity or the really high liquidity. But you sort of have to be careful what you wish for, because if you do end up finding a manager that is able to satisfy that in a very illiquid space, you can run into problems when there are issues with performance or investor withdrawals or whatnot.
Again, one last question. The question is on insider ownership.
Again, the answer is sort of, it depends, and it really does depend on the situation. I mean, generally speaking, yes, we like to see that. We like to see, just like investors like to see managers have, skin in the game, we like to see, management teams of microcap companies that we're considering investing in having ownership and expressing sort of confidence that way in their companies. But there are situations where the management team, maybe it's a family situation or whatnot, where they own perhaps too much of the company and therefore maybe aren't as interested in growing shareholder value for all shareholders. So there's no kind of like rule of thumb that we use, and I don't think a rule of thumb should be used. It's really, you have to take it on a case-by-case basis just to and make a judgment call as to whether interests are aligned.
With that, I'd like to thank you very much, Paul and Dennis. Dennis, would you like to? Yep.
I'd like to thank Bart. I know he's been it's been a prolonged effort to try to build a better CFA community down here in the South Sound, and I know he's been sticking with it, and I think he's done a tremendous job. I'm amazed when people were I would tell people I was coming to do this, and I'd say, I don't know how many. I think, 8 of my closest friends and a couple of Paul's. I don't know, but obviously the turnout is far more than I have friends. So Bart has done a tremendous job working on building the community down here. So thank you. Sorry to interrupt.
Thanks to both of you, and thank you everyone for coming, and we hope to see you at future events.